Market Master of the day is Hiren Ved, the CEO and Director and CIO at Alchemy Capital Management. He's joining us right now in our studios. Hiren, great to have you with us here on the program.
Thanks, Prashant.
Thank you very much, and thank you for dropping by. It's always a pleasure.
Thank you. Thank you for having me.
Hiren, how are you positioned? What's your view on the market? And because, I mean, it's been a super strong, outperforming market relative to everything else in the globe.
Yeah, and I think, we continue to remain very, very constructive on the market. We've thrown everything at this market, right, for the last 12 months, right from rising rates to inflation, to the Ukraine war, to the energy crisis in Europe. And despite that, if the market's just shy of its all-time highs, it's telling you something, that this is more structural. I think what's interesting for us is that the market's not very narrow like it was a couple of years ago. The breadth of the market is improving substantially. And a lot of the domestic-oriented sectors are doing very well, whether it's manufacturing, capital goods, defense, you talk about it, and then banks, right? So that tells you that, India is in a great position, despite all the challenges that we are seeing around the world. And I have no doubt that our markets structurally are heading to much higher levels than where they are today.
Okay. Hiren, hi, good morning. So, that clearly is something which is worked out in the market, right? The FMCG index, auto index, bank index, all at new highs. But given the environment in the global market, do you think at some point we'll play catch up? I know we've been talking about decoupling, but the global risk off is just too pronounced and the market's just been ignoring that.
Well, Anuj, I mean, the resilience has been great. Having said that, in the short run, what we've seen in the past is that usually if there is a deep cut globally, then a catch-up happens. But I think in the medium to long term, I still believe that Indian markets will decouple from the global markets, because I think we are in a very different situation and stage. Unlike in the past cycles where our macro was very, very challenged and FI flows were the predominant flows in the Indian markets. Today, you now have a very robust domestic liquidity, which is consistently going into the markets, right? And more importantly, I think what people miss is that I believe that we are on a structural earnings growth story in India, which got vitiated a little bit in the first quarter, and the second quarter we had not very significant, but a few downgrades because of higher raw material prices. But I think commodity prices have rolled over post that. And I think some of that, what we lost or we will lose in the first half, will likely come back in the second half of the year. And let's not forget that pre-COVID, the Nifty was at 12. Today we are at 18. We are 50% higher. But March 20, Nifty earnings was 440. March 22, which is already gone 6 months, we were at 740. Earnings were up 70%. The Nifty is up just 50%. So I think it's the other way. The Nifty needs to do a catch-up, right? And it's unless if you tell me that this year earnings are going to be negative, or next year you're going to get a degrowth in earnings, which I don't believe, will happen. So I think that, why this mental block people have when Nifty is up only 50% in 2.5 years, and we've got the best earnings story in the last 2 years. So, I think Nifty needs to do a little more.
Rather than half empty.
So this corporate profitability to GDP ratio has gone up quite a bit, right? I mean, it's already at a decadal high of 4.3%. We haven't seen that in a while, and that just begs asking whether the Nifty EPS needs to also be scaled up higher for the next year. Are you doing that? Because a lot of brokerages have done that. And if yes, what would the contributors be?
So I think, Sonia, you mentioned a good thing. We plotted if you plot the chart of aggregate profits to GDP, right from 90 to 93, right up until now, what you'll see interesting is that we typically tend to bottom out at somewhere between 1.5% to 2% of GDP. But once we bottom out and earnings start to improve, that ratio goes up 3x from where you were at the bottom, right? So you were at 2% in March 20. You're now at 4% in 2 years. And the previous peak we saw was in 2007-8 when we went to about 7.5% of GDP. More likely the next peak will be higher than the previous peak because that's what's happened in the last few cycles. But even for argument's sake, if you take 7 as a number and you say we will achieve that 3 years down the line, and then you work backwards, you will see that earnings will grow at 20% plus, right? What happens with consensus earnings is that typically analysts tend to take quarter by quarter approach because, you know, in the first quarter that just went by, you almost saw a 450 basis point knock on EBITDA margins YOY and 280 basis points quarter on quarter. Now, obviously, you can't take that into infinity, right? Some of that will come back because companies don't take price hikes in one go. They take it slowly over a period of time. Also, you have higher cost raw materials sitting in your inventory, which needs a couple of quarters to move out. So my sense is that by the second half of the year, you will probably see upgrades starting to happen, right? And I think, you know, autos, banks and financials, that's where the earnings growth, capital goods, that's where the earnings growth is likely to come through. So I personally feel that consensus is too bearish on earnings.
But consensus historically has been too optimistic on earnings, right? And now these are projections. Now it may happen, it may not happen.
And that's why they never get it right. Either they are too optimistic or they are too pessimistic.
You know, we had James Sullivan of JP Morgan with us earlier today, and this is a point we've discussed. I presented some data some time back, essentially showing how you know, a lot of flow is coming to India because there are other large emerging markets are not uninvestable, but they're much lesser attractive. And growth here, absolutely, macro management has been very strong. So all of that is point taken. But is it lack of alternatives where we're seeing this, not almost like a, for the lack of a better phrase, one-time adjustment, flows coming through to India? Or is it really earnings optimism? Because the earnings optimism story we've heard for many years now. It may come through still. I'm not saying it won't. But, you know, history says that it's better to be conservative on earnings expectations. FY24 Nifty earnings estimates were at 1,000 rupees.
More, plus 1,000 plus something, which has been cut to 950 or 960.
Yeah, right. So that's already starting to happen. The downgrades are already starting to come through. Your thoughts?
No, I think, I mean, look, as I said, you know, people see near-term earnings and then they pencil that in, right? My sense is that by the time you come towards the end of FY23, most likely your FY24 numbers will go back to 1,000 plus. That's my expectation. I could be wrong, right? Because I think that you can't have two things together. You can't talk about a recession in the world and commodity prices going up, right? So something has to give up. So I think some of that EBITDA margins that we lost will come back to us. Secondly, if you look at some of the lead indicators, credit growth, you look at auto numbers, right? I mean, that's all doing phenomenally well. And I think on your show, I saw the other day, I think somebody from Phoenix Mill was there and he said, look at the kind of retail.
The best ever
Diwali, festive, pre-festive shopping season that I've seen.
You can see that, right? I mean,
you can see that, right? Yeah. I mean, so I think, and on your point of, you know, no other alternative to invest, I don't think that's true because up until recently, they were selling in India. And despite that, the markets went up, right? And I think we should be happy that India is relatively better placed. At least at some point in time, we got our place in the sun, where, you know, where you don't have to market India and you know, money will come in.
Okay.
So I think, you know, we should celebrate and enjoy. However, having said that, I think we need to
avoid the hangover.
Avoid the hangover.
That's all.
But I think there's one aspect that we shouldn't kind of take our eye off the ball, and which is that this is on the assumption that oil prices don't go back up above $100. Because I think the cushion that we built in our FX reserves, I think we've pretty much used it up trying to defend the rupee at 80, right? We're still comfortable, but we're just about comfortable.
The cover has dropped to about 9 months now.
It's now dropped to about 9 months, right? So I think that's something that we need to watch, that we've been lucky that oil prices have started to roll over and are now at $90. But if it were to go back above $100, I think that would be a bit challenging.
Okay.
So we just need to keep that in mind. But otherwise, I think we're doing absolutely fine.
Okay, fair enough. By the way, I just want to point out the stock of the day could well be SBI Card. Just look at that move, 4% higher on that. Of course, for last couple of days, it was under pressure because of the chatter that NBFCs will be allowed to, get into the credit card business. Now, Lata's story, and she's saying that she got it from really impeccable sources, is that RBI is not looking at it anytime in the near future. And the stock has underperformed in a market where most of the financial stocks have done well. So that's why you're seeing this move 4% higher on that. Now, you're launching a new Category 3 AIF, right, Hiren? Why don't you tell us about that? You're going to choose 20 to 25 stocks. What kind of sectors, what kind of allocation will you have for individual names?
So yeah, I mean, up until now, we've always run a multi-cap strategy, right? We're now doing a specific small and mid-cap strategy called Emerging Leaders of Tomorrow. And we believe that the time is right for a dedicated small and mid-cap strategy. I just mentioned early on to Prashant that how we've seen the breadth of economic growth improve, right? So if you look at 2018-19, they were very difficult years for small and mid-caps. And we had such a narrow market with only the top 15, 20 companies doing very well. And I think for a long time, one theme which has been running through, which is of consolidation, the big getting bigger, the organized players taking away market share from the unorganized player. And I think that trend is well understood, well invested, and will continue. I'm not saying that's going to go. But underlying, there is another trend which I think is going to start, and which is that you will have a lot of young sectors which will become big, right? Because I think in India, manufacturing is coming out after a 10-year slumber, right? So we've not seen absolute profits scale the peaks that we saw 8-10 years ago in many sectors, whether it is capital goods, manufacturing. And I think post-COVID, in the new geopolitical situation with more and more Indian companies plugging into global supply chains and the focus on Atmanirbhar, there is a lot of dynamism in a lot of new sectors like new energy and renewables, in electric vehicles, in defense, right? When the auto industry became big in India, when Suzuki and Hyundai came, they created a whole ecosystem of auto component manufacturers. I think now we will see something like this happen in defense and in electric vehicles, where there will be a whole ecosystem of smaller engineering companies and service companies and software companies which are plugging into the supply chain, being ancillaries to the big boys in those sectors. So I think there's going to be a lot of fresh blood, fresh dynamism, new entrepreneurs, new industries which will come up.
Actually, on that note, I just wanted to ask you, there was a report that Jeffries had put out, and we got the strategist a couple of days ago, who said that India has the largest population of Gen Z in the world, right?
Yeah.
The 20 to 30-year-olds. And it's now exceeded China by 1.5 times. And they're the guys who are going to, of course, do all the spending as we move into the next decade.
Exactly.
So what do you see as the disruption?
But they don't want to spend, right?
They don't want to work.
They don't want to buy a house. They don't want to, terrible.
They don't want to work, but they want to spend, right? Go ahead. What do you see as
They don't want to work. They want to borrow on BNPL and spend.
Almost everyone's coming and saying that manufacturing is going to be the big bet.
Yeah.
I think I met 2 or 3 big investors, and almost everyone is going all in on manufacturing. Is that a risk then? Too much of a consensus?
Yeah, I mean, look, everybody says that, but let's see how many follow through and stay invested for the next couple of years. I think it is a real trend. It is a long-term trend for sure. That doesn't mean that there are no opportunities outside of manufacturing. I think the reason why we say manufacturing is because it was a lost decade for manufacturing, pretty much, right? And I think now manufacturing is coming back. And to your point, Sonia, I think, it's like this. Like 5 years ago, there was only one QSR company, right? Westlife, McDonald's, and then came Domino's, and now you have a bunch of 7, 8 of them, right? So I think there are many these new sectors which are coming up, and the only way to play is because you don't have large caps in those sectors. So you should start with small and mid-sized companies. Hopefully, some of them will become large cap, right? Just like it happened many years ago in NBFCs, and then some NBFCs became big, or generic pharmaceuticals in the 90s, which then became multi-billion-dollar businesses, or specialty chemicals 5 years ago, which is now still in its youth and growing. So we think there's going to be a lot of dynamism, a lot of opportunities in new sectors and new leadership, right? So while the action today is all about the big groups announcing large capex programs and doing consolidation across industries, but simultaneously we think that there's going to be a lot of dynamism at the lower end of the market.
It would
as
be
well.
great, Hiren, if you name names, but you won't. But tell us three group of businesses which you think, which one should kind of investigate, research, and where some of these names will emerge from.
So I think, as I mentioned, one is manufacturing, but manufacturing is a very broad term. But if I were to look at a few areas, specialty chemicals, defense, electric vehicles, I think broadly, and green energy, I think these are 3-4 areas where you will be able to find a few manufacturing companies which will be very interesting to play. On the IT side, I think you will start, we've already said this before, that there are smaller subsegments within the bigger IT pack, which is growing much faster, like ER&D companies, very specialized companies. I think you just have one company in data analytics. I'm sure you will see many more companies coming in data analytics, right? And the last, but the very interesting area is going to be consumption, which is either through restaurants or QSRs, travel. I think wherever there is premiumization, I think there is a big opportunity, right? I think as incomes in India go beyond $2,000, which is typically a tipping point from where discretionary consumption tends to do phenomenally well. I think there are a bunch of great specialized retailing companies, QSR companies, which could be very interesting. So I think these are some of the areas where we should be hunting.
This EV space, Hiren, is that a bit overstretched? And, especially in a country like India, where we're still struggling to get the right kind of infrastructure for the EV play.
Anuj, I think India is very innovative as a country, right? So what seems like an infrastructure bottleneck today, I won't be surprised if tomorrow a small side shop has a EV charger next to him because he can make some money off it, right? So just imagine when telecom proliferated. Even a panwala used to keep a small SIM card and a recharge facility, etc., right? So I think it's a little bit of a chicken and egg. Yes, we are in the early stages, so it looks like that there is a lot of talk and very little action. But numbers tell you that if you take the total two-wheeler market and if you see how fast EVs are growing, right? It's growing at much faster rates than normal. But we have a long way to cover. So it will take time, but I think it's beginning to happen, whether in four-wheelers or in two-wheelers. And now it's also coming into transportation goods. You had Tube Investments, which launched the three-wheeler in EV. So it's not that you're going to buy something today and make money tomorrow, but it's a trend that you got to look out for.
And the entities which are coming to the market will also grow with newer listings and newer businesses in each of these sectors that you highlighted, Hiren. So that provides more options as well in terms of businesses. Hiren, great to have you with us here. Thank you so much for dropping by.
Thank you.
Really appreciate your time here.